Greetings. Good morning. Apologize for being late. This hearing of the Subcommittee on Capital Markets is hereby called to order. Today's hearing is legislative proposals to modernize business development companies, also called BDCs, and expand investment opportunities. And without objection, the Chair is authorized to declare recess at the Subcommittee at any time. And at this point, before we go to our panel, we'll go to our opening statements and yield myself a couple, 2.5 minutes. Again, good morning. And again, I apologize for being a few moments late. Today's subcommittee will continue the important work that we are working on, considering legislative proposals that would modernize our nation's securities laws in order to do what? To foster greater economic activity. Now, one of these proposals is a discussion draft that is being circulated right now by the gentleman from South Carolina, Mr. Mulvaney. And what would it do? It would modernize the regulations of BDCs, business development companies. And what are BDCs? Well, BDCs are closed-end investment funds that have a statutory mandate to invest such much of their capital in small and medium-sized businesses. As new regulations have caused banks and other lenders to pull back from the small and mid-sized lending market, and we've heard that in other hearings, BDCs have played an increasingly important role in our economy and in that space. So while it has been 35 years since their creation, the regulatory regime for BDCs has not been meaningfully updated during that time. So Mr. Mulvaney's bill, which includes several provisions that this committee has previously considered, would do a couple things. It would enhance the ability of BDCs to deploy capital and therefore create jobs and opportunities as well for literally thousands of businesses and therefore also their employees. Now, aside from that bill, we have a second bill. The second bill we'll consider today is H.R. 2128. It's called the Fair Investment Opportunities Professional Experts Act, and that's introduced by the gentleman from Arizona, Mr. Schweikert. What would Mr. Schweikert's bill do? It would amend the definition of who qualifies as an accredited investor under the securities laws, and it is therefore eligible to invest in certain private offerings. Now, while the Dodd-Frank Act directed the SEC to review the current income and asset-based definition of what an accredited investor is, there is still substantial concern that the SEC could ultimately take action that would limit the number of Americans eligible to invest in private offerings, a market that right now has actually grown to over $1 trillion in recent years. You see, investing in private companies should not be a privilege reserved only for the super wealthy. And so Mr. Schweikert's bill would allow more Americans to have the opportunities to secure their financial future. So, taken together, these two common-sense bills would expand upon the previous work of the subcommittee in this very important area. And so, again, I thank the two sponsors of this legislation as well as the witnesses for the hearing today. And with that, my time is used, and I yield to the ranking member, 5 minutes, I believe. The gentlelady is recognized.
Thank you so much, Mr. Chairman, and thank all our panelists for being here today. And we're examining two bills, one to modernize the regulations for business development companies, or BDCs, and another is to revise the definition of an accredited investor. The BDC bill is very familiar to all of us in this Congress because we considered a similar bill in depth in last Congress. Since then, I'm pleased to say that we've made some very good progress on this bill, and the draft that we're considering today reflects input from the Democratic side of the aisle, the Republican one, the SEC, and the BDC community. I am hopeful that we can all get to a yes on this bill, which would increase the availability of capital for small businesses, and it's an important bill for our economy. We will also consider a bill by Mr. Schweikert to revise the definition of an accredited investor and how to draw the line between someone who is an accredited investor and someone who is not is one of the most difficult questions in all of securities law. An accredited investor is someone who, in the words of the Supreme Court, can, and I quote, fend for themselves and does not need the protections of the securities law. These sophisticated investors are allowed to buy unregistered securities, which are often more complex and riskier than public securities. Unregistered securities are also less liquid than public securities, which makes these investments in unregistered securities harder to exit or sell. As a result, these investments are supposed to be limited to investors who can legitimately bear the economic risk involved in buying them. These investors are referred to as accredited investors. Current law defines an accredited investor primarily by reference to a person's income or overall net worth. Someone whose annual income is greater than $200,000 is an accredited investor, or if someone's net worth, excluding the value of his house, is greater than $1 million. So the question really is, does this strike the right balance? Is everyone who meets these tests truly able to fend for themselves? The SEC's Investor Advisory Committee recommended a new definition of an accredited investor last year that seeks to more accurately identify investors with enough financial sophistication to fend for themselves. And I think this proposal is a very good starting point for this discussion. I look forward to hearing a discussion of the benefits and drawbacks of the Investor Advisory Committee's proposal versus Mr. Swikert's proposal. This is an important debate to have, so I thank Mr. Swikert for putting it forward, and I'd also like to thank Chairman Garrett for holding this hearing and all our panelists.
And the gentlelady yields back, and I thank the gentlelady for her comments. And at that point, we turn to our panel. And again, I thank the panel for being with us today, and I see some familiar faces. For those other than familiar faces, let me just remind you, you will be recognized for 5 minutes. I think there's a button there in front of you to tell you the time to start, and also a indicator in front of you of some sort. It'll go down to 1 minute on the timing for that. We are in a new room now, so we'll see just how well the microphones are working. I used to always have to ask the people to pull the microphone close to you when you speak, but we'll see how it works here now. And finally, you'll be recognized for 5 minutes, but of course you've already submitted your testimony, and that'll be made part of the record, so now we just yield to you for 5 minutes to summarize your testimony. Mr. Arrighetti, welcome to the panel, and we look forward to your testimony. You're recognized for 5 minutes.
Great, thank you. Chairman Garrett, Representative Maloney, thank you for the opportunity to testify today. I'm Michael Arrighetti, the co-chairman of the Board of Directors of Ares Capital Corporation, a BDC that has invested more than $20 billion in hundreds of small and medium-sized companies, creating tens of thousands of American jobs. By way of reminder, Congress created BDCs in 1980 to encourage capital flows to small and medium-sized companies, at a time when these businesses had limited options for securing credit. Now, uniquely, the BDC model allows ordinary investors the ability to participate in capital formation for small companies, effectively Main Street funding Main Street. Now, today, similar to 1980, commercial banks continue to exit the middle market lending space. Perhaps the most striking recent example of this is GE Capital's exit from the lending space. As the 7th largest bank in the U.S., this will surely have a further significant adverse impact on the small and medium-sized businesses who have traditionally borrowed from GE Capital, and obviously on the jobs that these businesses have contributed to the economy. I'm here today to express support for the draft of the Small Business Credit Availability Act being offered by Mr. Mulvaney. We believe that the proposed bill will enable BDCs to more easily raise capital and to make loans to middle market companies while ensuring that BDCs continue to be appropriately regulated and subject to stringent standards regarding transparency and obviously shareholder protection. I think it is important to note that BDCs are not seeking any government or taxpayer subsidy or support. Many of the challenges that we face as BDCs arise out of our peculiar place in the regulatory framework, regulated as mutual funds, yet operating as operating companies. The draft bill builds on H.R. 1800 and other bipartisan efforts in the previous Congress to modernize this regulatory framework and to ensure that BDCs can continue to fulfill their original congressional mandate. The proposed bill contains 5 provisions, each of which we believe will enable BDCs to more effectively fulfill their congressional mandate. First, the proposed bill contemplates an increase in the BDC asset coverage test from 200% to 150%, subject to the satisfaction of shareholder-friendly conditions, such as extensive public disclosure and transparency, and either a shareholder vote or a quote-unquote cooling-off period following approval by the independent members of a BDC's board of directors. We don't believe that this introduces more risk. Rather, it will allow BDCs to invest in lower yielding, lower risk assets that don't currently fit their economic model. In fact, the current asset coverage test may ironically force certain BDCs to invest in riskier, higher yielding securities in order to meet the dividend requirements of their shareholders. We also believe that this change will grant borrowers greater financing alternatives at a reduced cost and will benefit shareholders with more conservative and more diversified portfolios. Further, this change will enable BDCs to lend to a broader portion of the already underserved middle market. This proposed change would apply to BDCs the same leverage ratio as small business investment companies, but unlike SBICs, without putting any government capital at risk. Further, given that the House Small Business Committee just last week passed bipartisan legislation increasing the size of the SBIC program, the proposed change certainly seems reasonable. It's also extremely modest relative to typical bank leverage in our country of 10-to-1 and sometimes greater. Under the current asset coverage test, most BDCs operate at leverage significantly less than allowed, and any prudent manager would likely continue this practice if the asset coverage ratio were to change. Secondly, the proposed bill would allow BDCs to issue multiple classes of preferred stock and solely for qualified institutional buyers, eliminate the requirement that holders of preferred stock have board representation. Had BDCs been able to raise capital during the post-2008 period by issuing preferred, many more loans could have been made to cash-starved companies to enable them to retain employees and in some instances to remain in business. Third, the proposed bill directs the SEC to make specific technical amendments to certain securities offering rules that make raising capital cumbersome and inefficient. And these rule changes are not controversial and would merely place BDCs on equal footing with non-BDCs. Fourth, the proposed bill would allow BDCs to own registered investment advisors, which as a technical matter is currently prohibited under the 1940 Act. Investments in RIAs enable money to be raised from third-party investors, which in turn can be deployed to small and medium-sized companies. And fifth, the proposed bill would offer increased flexibility for BDCs to invest in a subset of entities currently limited by the 30% basket. Importantly, this provision would not allow the amount of the incremental increase in the 30% basket to be invested in private equity funds, hedge funds, or CLOs. So in closing, I'm very encouraged by the bipartisan focus on this very important initiative, and I look forward to working with Representative Mulvaney and Representatives Garrett and Maloney and the rest of the committee in moving these bills forward. I would also like to applaud the committee's efforts to revisit the definition of accredited investor, which, like the BDC regulatory framework that we're discussing today, could indeed benefit from modernization. And lastly, as a procedural matter, Chairman, if I could, I would like to introduce a letter into the record from one of our portfolio companies that was referenced in my written testimony.
If it's part of your written testimony, it'll be part of the record.
Thank you.
Thank you. Thank you. From Main Street Capital, Mr. Foster.
Good afternoon, Chairman Garrett, Ranking Member Maloney, and members of the Subcommittee on Capital Markets and Government-Sponsored Enterprises. I appreciate the opportunity to testify today on behalf of the Small Business Investor Alliance, or SBIA. SBIA's members provide vital capital to small and medium-sized businesses nationwide, resulting in job creation and economic growth. My name is Vince Foster, and I'm Chairman, President, and CEO of Main Street Capital Corporation, an SEC-registered BDC based in Houston, Texas. We are named Main Street for a reason. Main Street is who we are and where we invest. As our name makes clear, we have invested in over 400 small and mid-sized companies. That amounts to more than $4 billion invested into growing businesses that were not able to adequately access capital through traditional financing sources. Like many BDCs, we focus on smaller businesses. We partner with entrepreneurs, business owners, and management teams that generally provide one-stop financing alternatives. Currently, we are backing over 70 lower middle market companies headquartered in 24 states. More than half of these businesses have revenues of less than $25 million. To illustrate this diversity, we have funded two of the fastest growing technology companies in Eugene, Oregon, the largest privately owned jewelry store chain in the Rocky Mountains, headquartered in Twin Falls, Idaho, one of the largest Goodyear tire retailers in the U.S., headquartered in Austin, Texas, the leading micro-irrigation design and installation company in the San Joaquin Valley, headquartered in Delano, California, the leading FBO at the Indianapolis Airport, one of the largest fully integrated precast concrete companies in Texas, headquartered in San Antonio, and one of the only 2 independent producers of styrene butadiene rubber in the U.S., headquartered in Baton Rouge, Louisiana, just to name a few. We've also invested in GRT Rubber Technologies, headquartered in Paragould, Arkansas, which was founded in the 1880s and manufactures engineered rubber products, including conveyor belts, and Bridge Capital Solutions, headquartered in Hauppauge, New York, which operates Long Island's only licensed commercial check cashing service serving small businesses in New York. Today, Main Street has small business investments in at least 15 of the 24 states represented by this committee, and we are just one of the over 34 BDCs that are part of SBIA. Small and medium businesses need growth capital, and BDCs are growing to fill that need. BDC loan balances have tripled since 2008 and are not slowing. Growing businesses are going to continue to need more capital. BDCs will benefit from modernization, but small businesses will be the ultimate beneficiaries of reform. BDCs are highly regulated and highly transparent. The public can look up and review every one of our investments. The BDC industry is not seeking deregulation or any changes to Dodd-Frank. We have earned investor trust and grew stronger in the face of economic calamity. We earned our good name, and we will work to keep it. What BDCs do need is common sense modernization. I might need Mike to help me lift this up. Look at this stack of paper. This is our SEC filing to issue stock. Hundreds of pages representing wasted money and manpower. Here is what CIT, $50 billion versus our 1.5, has to file to get the same result, because they can incorporate their other SEC filings by reference, but BDCs cannot. Do 4 more inches of paper protect better than a half an inch? No one is protected by the failure to modernize the rules for BDCs. This discussion draft would fix this absurdity and make a host of other clearly needed reforms. These reforms are overdue and worthy of bipartisan support. We encourage the committee to act promptly. This committee has clearly worked on a bipartisan basis to make other reforms and improvements. For example, almost every BDC in the industry wants the freedom to access the markets by increasing the regulatory cap on leverage from 1 to 1 to 2 to 1. Not everyone will make the change, but they want the freedom to adjust to changes in the market. The proposal does this in a very smart fashion that adds meaningful investor protections while adding capacity for investing. The draft bill makes other smart reforms that can add investor protections with transparency. Currently, BDCs can own registered investment advisors, but it requires SEC exemptive relief. This means BDCs are playing by different rules, and the investors are in the dark. Standardizing the relief makes a level playing field and provides clarity for investors. This, too, is a smart reform that is worthy of bipartisan support. The bill includes a number of other reforms. Many are technical, but they matter, particularly for smaller and growing BDCs. Every section of this bill shows thoughtful collaboration and improvements from previous bills. As the committee works through any fine-tuning on the bill, SBIA would encourage the committee to continue to keep the process moving and work to get real reforms signed into law this Congress. I would welcome any questions that you might have for me. Thank you.
And I thank the gentleman. The gentleman yields back, and later on we'll hear from the gentleman from Maine, whether he has any comments about the less use of paper products being produced, but we'll wait for his comments later. So from Franklin Square next, Mr. Gerber is recognized for 5 minutes.
Thank you, Chairman Garrett, Ranking Member Maloney, and the rest of the members of the committee. Thank you for the opportunity to testify today. My name is Mike Gerber, and I'm an Executive Vice President with Franklin Square Capital Partners. Franklin Square was founded in Philadelphia in 2007 with the mission of offering institutional quality alternative investments to mainstream American investors while leading the industry in best practices, transparency, investor protection, and education. To that end, we launched the industry's first ever non-traded BDC in 2009. We successfully listed that fund on the New York Stock Exchange in April of last year to create liquidity for our investors. Today, we manage 4 BDCs and have more BDC assets under management than any other manager in the industry. Franklin Square has investors in all 50 states, and we have portfolio companies in 39. Importantly, we have delivered strong risk-adjusted returns for our investors. As you all know, the 1980 law that created BDCs was passed with strong bipartisan support and was designed to stimulate investment in U.S. companies by matching mainstream investors' capital with Main Street businesses. Because BDCs are designed for retail investors, they are appropriately heavily regulated. In fact, whether traded or non-traded, BDCs are among the most highly regulated investment vehicles in the marketplace. And because of the extensive public filings, some of which you've seen right here, BDCs are fully transparent to regulators and investors alike. Our culture at Franklin Square is to embrace this regulation. In fact, it is part of how we market ourselves to financial advisors and investors. Specifically, BDCs register shares under the 33 Act and elect treatment as a BDC under the 40 Act. In addition, a BDC is subject to the 34 Act as a public company, meaning it must file 10 Qs, 10 Ks, 8 Ks, and proxy statements. Contained in every Q and K is a schedule of all of our investments, along with details such as the name of the portfolio company, the size of the loan, the rate of the loan, and the current mark of the investment. Other key protections include mandatory third-party custody of all BDC assets, a board of directors, the majority of whom must be independent, and board approval of key matters, such as management fees and quarterly valuations. In addition, our non-traded BDCs are also regulated by FINRA and by the Blue Sky securities regulators in all 50 states. Taken together, these laws and regulations ensure that BDCs are extremely transparent, minimize conflicts of interest, and provide investors with a high level of protection. One of the key mandates under the law requires BDCs to invest at least 70% of their assets in U.S. private and small cap companies. As a result, our BDCs at Franklin Square provided a significant amount of capital to middle market job creating companies. Middle market businesses employ more than 47 million people, or 1 out of every 3 workers in the private sector. In fact, between 2008 and 2014, middle market firms grew jobs by 4.4% versus 1.6% for big businesses, and unfortunately a 0.9% decline with small businesses. And now 39% of middle market companies say they expect to grow and add more jobs in 2015. Middle market lenders like BDCs, therefore, must be poised to provide the capital necessary to help fuel this anticipated growth. Currently, there are 84 BDCs representing approximately $70 billion in investments. At Franklin Square, we have deployed $27 billion since inception, including $10 billion in directly originated loans. The primary tool offered by Mr. Mulvaney's legislation that would help BDCs support more job-creating middle-market companies is the increase in the debt-to-equity ratio from 1:1 to 2:1. We believe this increase in leverage is modest and makes sense for 3 reasons. First, BDCs would have more capital available to meet the demand of middle-market firms while keeping all of our investor protections in place. Second, this would permit BDCs, as Mr. Arrighetti explained, to build safer portfolios, delivering the same or higher returns while taking on less risk. And third, even with the proposed increase, 2:1 leverage would still be quite low when compared to other lenders in the capital markets. For example, banks today are levered anywhere from 8:1 to 15:1, and hedge funds are levered in the mid-teens to the low 20s. We believe it would be good public policy to increase the lending capacity of BDCs and promote the more heavily regulated, more transparent BDC model. The discussion draft contains several additional provisions which I address in my written testimony and am happy to cover in Q&A. I'd like to close by thanking Representative Mulvaney for his work on this legislation, and I look forward to answering questions from the committee.
Thank you. Now from the Center for Capital Markets Competitiveness, Mr. Globman, welcome back to the panel. You're recognized for 5 minutes.
Thank you, Chairman Garrett, Ranking Member Maloney, members of the subcommittee. Markets provide investors with the opportunity for return and businesses with the potential to grow. Markets must have an even playing field and certainty in order to achieve these purposes. But we also live in a global economy. So this past February, the Chamber released a report, International Markets, a Diverse System is the Key to Commerce, which was written by Professor Anjan Thakur of Washington University. And what that report found was 2 things. For businesses to operate in this global economy, they need to have diverse forms of financing. Secondly, capital will go to those markets that are most efficient, and businesses will go to where the capital is. Therefore, in this global competitive environment, we have to keep in mind that the United States is not the only destination for capital. Indeed, others, including the European Union, today are currently considering proposals to make their market-based financing more efficient in order to spur their capital formation. So these bills and the hearings that this subcommittee has been holding this year are very timely. The business development corporations are filling a void for the mid-sized businesses and providing an alternative means to raise capital as other options have dried up over the years. We want to thank Mr. Mulvaney for introducing the Small Business Credit Availability Act, and we support it. While BDCs have only been in operation since 1980, it is only in the last few years that they have become an attractive means of capital formation for businesses. Indeed, the Chamber has supported past bipartisan efforts to increase BDC activity, and we believe that this bill addresses the concerns that were raised in prior legislative debates as well as by the SEC. This bill will provide greater capital and flexibility in investments while still having BDCs as a regulated entity. BDCs will increase, but still on a limited basis. The Chamber also supports robust disclosures and investor protections with BDCs so that retail investors have both the opportunity to understand the upside as well as the risk of investing in BDCs. We believe that the Mulvaney draft bill achieves that purpose. I'd also like to address the Fair Investment Opportunities for Professional Experts Act. We need to have limits to allow sophisticated investors to invest in private companies and to access complex investment vehicles. We need to do this to ensure that unsophisticated investors are not harmed. The Chamber supports objective tests such as asset and income thresholds to determine accredited investors. Mr. Schweikert has thoughtfully pointed out that there may be some on the periphery who should be allowed in, and we have some suggestions on how to improve the bill. First, those who are licensed and certified to sell securities should be considered to be a sophisticated investor, but with caps to ensure that their investments match their financial wherewithal. Secondly, we understand the intent behind the FINRA test and think it is an innovative way to get at the solution. However, a test is also subjective. We would prefer that the SEC be authorized to study the issue. What are the characteristics of a sophisticated investor? What are some of the innovative ways to bring those in a safe manner? And then to have the SEC report back to this committee as to what some of those innovations should be, and that those should be brought in under limited circumstances. Additionally, we have concerns on the language regarding the use of financial intermediaries conveying an accredited investor status to retail investors. While we understand the intent behind that provision, we are concerned that it will subsume the rule itself, the exception will subsume the rule, that it would also place some unsophisticated investors at harm, as well as increase liability for financial intermediaries. But we think this is a good step forward, and we're happy to work with Mr. Schweikert to make this reality, the bill a reality. The Chamber feels that these bills will enhance the competitiveness and increase opportunities for return, growth, and job creation. We look forward to working with the sponsors of this legislation, both bills, with the subcommittee, and to improve them, as well as to include these vehicles into a Jobs Act 2.0 that we hope can become law in this Congress. Thank you.
Thank you. And finally, last but not least, Professor of Law from Denver, Mr. Brown, or Professor Brown. You recognize?
J is fine.
There you go.
Chairman Garrett, Ranking Member Maloney, members of the subcommittee, it is a privilege to be here today. In addition to my position at the University of Denver Stern College of Law, I also serve as the Secretary to the SEC's Investor Advisory Committee. The remarks I make are, however, my own and do not necessarily reflect the views of the other members of the IAC. With respect to H.R. 2187 and the definition of accredited investor, let me give a bit of context. The SEC's definition of accredited investor for individuals was set out in 1982. While the dollar amounts have largely remained unchanged, the financial landscape has undergone tectonic shift. The markets have, of course, grown in complexity, but most significantly has been the shift from pension plans to defined contribution plans. Almost everyone with retirement savings today has a 401k or an IRA. The result has been what I believe is a dramatic increase in individual responsibility for managing the retirement nest egg. Likewise, the number of retirees is increasing rapidly. Every day, 10,000 baby boomers reach the age of 65, a trend that will continue until 2030. Many of these older investors are unsophisticated and lack, as one study put it, even a rudimentary understanding of stock and bond prices, risk diversification, portfolio choice, and investment fees. With the end to the ban on general solicitations, our retirees and other investors can now be offered unregistered investments through indiscriminate forms of mass marketing, including blast emails, ads on the Internet, infomercials, and seminars. So, imagine our 85-year-old parent or uncle or friend who gets the unsolicited phone call or the pitch at a free lunch to invest in pre-IPO shares, or, I'm from Colorado, the marijuana business. If that doesn't work, how about a children's television network or a company that is making a grandchild-safe alternative to the Internet? All of this brings me to the definition of accredited investor. The definition needs to include those who are sophisticated and exclude those who are not. In reforming the definition, I believe there is more agreement than disagreement. There is agreement that it should be changed to include the people who are sophisticated in fact. The recommendation of the SEC's Investor Advisory Committee has set out standards for when this should occur, basing sophistication on education, experience, and testing. The dollar thresholds also need re-examination. It may mean increasing the amounts. It also may mean changing the way the amounts are calculated. Maybe some portion of retirement assets should be excluded from the calculation. Even people who oppose changes to the numerical thresholds, I believe, are mostly worried that a sudden increase in the dollar amount will significantly reduce the number of accredited investors. But if the definition is reformed simultaneously to make the income and net worth standards a better predictor of sophistication and allow individuals to also qualify on the basis of education, experience, and testing, I believe that all sides in the debate will benefit. With respect to H.R. 2187, my written testimony has a more complete critique, but let me just offer these observations. First, the draft legislative proposal does not deal with our 85-year-old parent or uncle or friend who is in fact unsophisticated but qualifies as accredited because of the net worth test. Second, the bill treats as accredited whole categories of individuals such as lawyers. Lawyers are not invariably rendered sophisticated as a result of education or practice area. Extending the definition to persons who are not sophisticated is of particular concern since these individuals are not required to meet the numerical thresholds and may not be in a position to withstand the loss. Finally, a serious risk is that regulators charged with implementing this legislation will stop other efforts. The bill leaves out other groups that ought to qualify as accredited as a result of experience and education. The SEC is working on a study in this area that ought to include some recommendations. The Commission is in a good position to achieve the grand bargain that I think is needed and should be allowed to complete the process without legislative intervention. Very quickly, with respect to business development companies, I think that the increase in leverage proposed under the legislation will raise the risk profile for at least some of these companies, but disclosure is an appropriate method of addressing the issue. My most significant concern is with the changes that would allow BDCs to redeploy a higher percentage of their assets away from operating companies to financial firms. In 1980, Congress, in adopting the legislation, creating BDCs, sought to provide additional funding and managerial advice to operating companies. Why these companies? As the House report said then, the committee is well aware of the slowing of the flow of capital to American enterprise, particularly to smaller, growing businesses, that has occurred in recent years. The importance of these businesses to the American economic system in terms of innovation, productivity, increased competition, and the jobs they create is, of course, critical. Hence, the need to reverse this downward trend is a compelling public concern. I suspect that this is no less true today than it was in 1980, and that these companies remain critically important to our economy and the creation of jobs. I think that any reform in this area should not change the framework in a manner that may disadvantage the very kinds of companies that the legislation was originally intended to assist. Thank you again for providing me with the opportunity to be here today.
I appreciate your comments. So thank you to the panel. And so at this point, I recognize myself for 5 minutes. So I'll go in reverse order. And again, I thank the gentleman from Arizona for his work on accredited investors, change of definition. I guess our one takeaway from Professor Brown is that lawyers are not sophisticated. Will we have consensus on that from everybody on the panel, that lawyers are not sophisticated? Okay. So moving on from that degree of consensus. So isn't, on the issue of accredited investors, isn't it an issue of somewhat of fairness too, of as far as having drawn a distinction in class as to who is allowed to have the opportunity to these investors versus which class of people in the country don't have the opportunity? Because what I'm thinking when I was hearing the professor's talk, that those people that you were defining the retiree or what have you, currently probably don't fit into that definition of accredited investor, but they have the opportunity to do all sorts of other investments with their money. Mr. Foster showed the disparity between BDCs and public companies, and so those public companies are available on all the exchanges and what have you, and the unsophisticated investor can be making life-changing investments in all of those. Of course, in most of those investments, you don't necessarily see the rate of return that you sometimes see in a BDC. I see some nods on that. So is this, I'll maybe throw it to Mr. Gerber, is this an issue of degree of fairness as far as the distinction that will be allowing those who should be able to have the opportunity to get into these investments who currently are precluded simply by law? Sure.
Thank you, Mr. Chairman. Just a point of clarification.
I should probably not have shown that through Mr. Gerber.
No, that's okay, but I think maybe important to mention this on behalf of the BDCs. To invest in a publicly traded BDC, a person does not need to be an accredited investor.
Right.
Number one. Number two, to invest in a non-traded BDC, investors, that transaction is regulated by the blue sky laws in each of the states, and all the states have their own suitability standards that apply to whether or not an investor is appropriate for.
So let me throw it over to Mr. Quadman as far as the rest of the investment field.
Sure. I mean, Chairman Garrett, you raise a very good question. I mean, because we have a robust private company market. Most businesses in the United States are private. So what we need to do is ensure that we have capital flows into those private companies to ensure that they have the liquidity to grow and operate. What is also important as well is that with public companies, we have a vast amount of disclosure with the notion that investors can go in there and make whatever decision they want because they can access the information. What we want to do with the private companies is ensure that you have people with the knowledge base and the wherewithal to go in there and to invest in companies.
So let me stop you there and throw back to Mr. Gerber then, because you were saying that these are not, which is correct, with regard to accredited investors in BDCs. Satisfy for me then that there is enough transparency, information, and the like for that class of non-accredited, so non-sophisticated in that realm.
With respect to BDCs, as I mentioned in my testimony, Mr. Chairman, we fall under the 33 Act, the 34 Act, and the 40 Act. So in the BDC context, there's a load of transparency and a ton of information is provided to investors, just the same as a publicly traded company.
So who is it when you're trading in these, and where is that information actually gotten to? In other words, where the investment is certainly done through your broker or what have you, and the security is in the street name, is that actually getting back to me as the nominal investor in that situation?
It certainly can be. So it's available on the SEC website, EDGAR. It's available on all of our websites. So it's easily accessible.
So what about, and I'll throw anybody else who talk about the BDCs, what about what's in Mr. Mulvaney's bill as far as changing the leverage ratio, as far as getting sufficient transparency there back to the actual investor who may not actually be in the street, may not actually be the street name investor? Anyone wants to chime in on that?
Yeah, I think as we talked about this proposed legislation relative to prior attempts to increase the asset coverage ratio, I think the combination of a form of shareholder vote and a quote-unquote cooling off period provides the adequate shareholder protection. So as this bill contemplates, the independent board of directors would make a determination that they would like to access the increased asset coverage ratio.
Yeah.
And then under the securities regulations, an 8K would need to be filed publicly to make public notice of the intention. And then obviously the shareholders will have 12 months of a cooling off period to effectively vote with their feet. So even in the event that there wasn't a shareholder vote, it would give people free time to determine whether or not they wanted to stay within that investment.
Okay, great. Thanks. Appreciate that. I have some other questions with regard to the testing requirements, but I'll throw it to the gentlelady from New York.
Thank you, Mr. Chairman, for calling the hearing, and thank all the panelists. I'd like to ask Mr. Argaiati, I'd like to ask you about the additional leverage that the BDC bill would allow. Of course, we're still talking about very low levels of leverage. The bill would only increase the maximum leverage ratio from 1-to-1 to 2-to-1, but it's still a higher leverage. What would your company do with the higher leverage that this bill would permit?
Sure. So I think as Mr. Gerber said in his testimony, it is not abundantly clear that every company will actually take advantage of the incremental asset coverage ratio. I think one of the wonderful things about the BDC industry is that it services all types of companies, from venture finance companies all the way through to larger middle market companies. And even on this panel, you have companies who focus on the lower middle market with a more equity orientation, through to folks like ourselves who focus more on larger market senior secured loans. So what Ares would likely do would be to increase the scope of its lending activities, probably become more senior secured and therefore less risky in our investment positioning, and use the incremental leverage, back to Mr. Gerber's commentary, to drive the same, if not higher, returns to our investors, but taking less risk at the asset level.
So how much of the additional money would go to increase investments in the so-called 70% bucket for small businesses? It would give you more money to, more liquidity to put out to these smaller businesses.
Right. So all of that capital should theoretically find its way to small business. So maybe addressing, at least for Ares, the 30% basket as we use it has two concentrated positions in it today. One is called the Senior Secured Loan Program, which is a joint venture that we had with GE Capital that we use to actually make middle market loans. And the second is in the form of a company that we call Ivy Hill Asset Management, which similarly is in the business of making middle market loans. So at least from the Ares strategic perspective, we've been using our quote-unquote 30% basket to in fact make middle market loans to small companies.
I'd like to ask you and also Mr. Foster about the discussion draft of the BDC bill, which would allow BDCs to invest more of their assets in finance companies. And as Mr. Foster testified, the intent of the first BDC bills was to direct these monies towards goods and services that are really underfinanced and need this help. Are you concerned that this change could change how BDCs are viewed by investors and analysts? And what's your feeling about being able to invest more in finance companies as opposed to goods and services? And I'd like first to hear from Mr. Foster and Mr. Argaiati, but also any comments from anybody else on the panel on this question of allowing the finance companies.
Sure. Well, the BDCs in the SBIA have generally been polled by the staff, and in general, there's a consensus with respect to the BDCs, the 34 BDCs in the SBIA, not 100%, but a general consensus, is that this additional flexibility, would be nice. It's not a priority at all, and I don't think many of us would take advantage of it. We personally would not take advantage of it. I think you would do so at your own risk, to the degree you alienated some of your shareholders or what have you by changing your business plan. On the other hand, we're permanent vehicles for capital, and there's a constantly changing array of investment opportunities out there, and the credit cycle goes up and down. So to me, it's kind of like the swimming pool in the backyard. I really don't use it, but it's nice to, it's nice to know it's there if I ever want to use it, and I think that's the general consensus of the SBIA.
Mr. Arguetti?
Yeah, I think about this two ways. One, just in the context of modernization. And as we sit here today talking about legislation that was passed 35 years ago, while many things are still similar in terms of the capital void for middle market companies, the structure of the financial markets has changed. And things like small ticket leasing, things like factoring, things like receivables financing, all exist today in a way that they didn't exist 30 years ago. So as one example in our portfolio, we have a leasing company that makes office equipment leases to small business.
Okay, my time is almost expired, and I'd like to hear Mr. Foster's reaction to it, too. I only have 7 minutes left. Excuse me, Mr. Brown's.
You know, my biggest concern is that there will be funds redirected away from operating companies and to these financial firms. I don't know if financial firms need the funds in the same way that operating companies do, but there's a defined need here for operating companies. And I think before the legislation allows for the redirecting of funds away from those companies, it should have a stronger empirical basis for determining that that's a more appropriate use of funds.
Thank you. Thank you. Gentleman from Texas is recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks for holding this hearing. Mr. Arguetti, Mr. Brown had said that, you know, increasing the leverage ratio would be harmful has potential to be harmful to the investors. But what I heard you saying is that, you know, you would use that leverage in a way to enhance shareholder value, wouldn't you?
Yes, I would. I believe, and I think it's just common knowledge in the investment business, that the introduction of leverage could amplify risk the same way it could amplify return. So I'd be remiss to say that there's not the possibility that could theoretically improve risk. But what I believe Mr. Brown also said is that the benefits, provided there's adequate disclosure, which this legislation provides for, far outweigh those potential risks. One thing I think it's worth highlighting is that the structure of the market already accommodates the leveraging of lower risk assets. In fact, within the BDC industry, where we borrow from banks, they give us a schedule of investments identifying how much they are willing to leverage our various investments. And from that list, starting with common equity all the way up through senior secured loans, what you'll see is a market's unwillingness to leverage equity investments and a market's willingness to leverage senior secured loans well in excess of the proposed 2-to-1. So outside of the BDC construct, the idea of risk-based leverage is pretty well established, and even within the BDC framework, the existing leverage facilities are already in place to accommodate that changing leverage requirement if the 1-to-1 overlay were widened.
So if this bill passes and becomes law, you don't see this big rush out to all of these companies to leverage up, because basically you've got a business model and there's a certain amount of opportunity out there. You just have to determine how you can best fund that.
Yeah, I think that's exactly right. And again, one of the things that we have seen over the last decade as BDCs have grown, as I mentioned, there are various business models. There are certain BDCs who lend exclusively to venture-backed companies who may be pre-revenue or pre-cash flow, and those will attract a certain amount of de minimis leverage. And then there are people like ourselves who would probably be moving into lower risk senior secured leverage and attract a different balance sheet profile. So I think that that's one of the nice things about the bill.
So do you see the growing of the BDC market increasing as we've seen a diminished participation in the banking community?
Yeah, I do. I think the growth in the BDC market has been significant, but not nearly enough to keep pace with the growing capital void. So I would hope that this legislation would in fact spur capital formation.
And from the panel, I mean, these are some ideas that, thoughtful ideas. Are there other things in that space that we need to be thinking about that isn't addressed in this legislation that would encourage the BDC activity and help, more importantly, help, you know, small businesses access capital? Mr. Foster, you look like you.
Thank you. Yeah, I mean, the first thing that's going to happen, all three of us are investment grade rated by S&Ps. We're the most creditworthy of the BDCs out there. And the first thing we're likely going to do if the legislation passes is sit down with the rating agencies and talk about their reaction, if any, to it. And they probably won't have a reaction just because we can have more leverage doesn't mean they're going to allow us to have more leverage, and I don't think any of us are going to take on more leverage if it means a ratings downgrade. Similarly, like Mr. Arrighetti said, we'll sit down with our banks and say, you know, what, if anything, are you willing to provide us now that we have the ability to have slightly more leverage? And so there's a lot of self-correcting mechanisms the way we all operate, where you're not going to see a huge amount of immediate leveraging. You're going to sit down with your constituents, you're going to figure out what makes sense. But I think the shareholders are the winners at the end of the day, and I think there's businesses out there that we can't reach that we're going to be able to reach, but I think it will be selective, and I think it will take some time.
Mr. Quadman?
Sure. Chairman Neugebauer, just 2 points I wanted to make with that. One is, if this bill were to pass, become law, and we see the activity move forward, I think this is also a great example of something that should be taken up by Mr. Hurt's retrospective review bill that was raised in the last hearing, that we can the SEC can come back in 5 years, take a look at the activities, see if anything needs to be changed, or how BDC activities can be changed more to, become a better capital formation facilitator in the marketplace. The other point I just wanted to raise too, and this goes back to the last question, with the 50% cap, my recollection is with the previous bills that were under consideration in the last Congress, there was no such cap. So this 50% cap in the Mulvaney bill actually provides a lower, or potential lower level to financial companies. I think actually helps operational companies in that regard.
Thank you, Mr. Chairman.
Gentleman's time has expired. The gentleman from California.
Thank you. Mr. Brown, one definition of that would be added for accredited investors are those who have retained, use the services of various advisors. As you understand the legislation, would that mean that an investor could just retain the advice of an advisor who's affiliated with, selected by, or compensated by the issuer?
I don't think there's anything in the legislation that prevents that. It defines categories, and all you have to be is in one of those categories of people in order to be considered someone who can provide the services that transform you into an accredited investor.
So if I had a product I wanted to get investors in, and let's say I had a perverse interest in selling to those who couldn't even afford the risk, I could just have a CPA or lawyer on staff and say, you can advise each investor, and I'll pay you to do it. And or you'll earn a commission with regard to the investment. I don't see any of the other witnesses anxious to contradict that, so I hope we would correct that in the legislation and say that if you're going to be an accredited investor because you've got a good advisor, that advisor better not be affiliated with, selected by, or compensated by the issuer, nor should his or her compensation depend upon whether the investor chooses to make the investment. We have, when I was in the business world, which was a long time ago, we established this $1 million rule. $1 million now isn't even a good house in many parts of my district, and this $200,000 income used to be those who were really rolling in money. I would point out that even members of Congress would be making $200,000 if we hadn't legislated to prevent ourselves from getting cost of living increases. And I would hope that we would take a look at this if we're going to liberalize the rule by saying, well, if you're getting good advice, you don't have to be a millionaire. We would realize that in today's world, a millionaire is somebody that's got at least a couple $1 million. To say that somebody's a millionaire because they have a net worth of $1 million ignores the inflation over the last 20 or 30 years. As to leverage for BDCs, what we have in our economy now is all the money is locked in banks and other very risk-averse investors. if you want to get a prime loan or a prime plus one loan, you know, you can get 10 banks to bid on it, and you get all the money, and they beg you to take more, and you say no. If the German government wants to borrow money, you have to pay them to take it. So those that are, the money's locked up, and if we can get some of that money lent to BDCs, and then through BDCs extended to the companies that really need it and that are growing and that, or might grow and that have some risk, that's moving the money from this little sheltered world where it only gets lent to sovereign governments and et cetera, and gets out. Which is why I'm a bit reluctant to see, I think Mr. Brown commented on this, to see the BDC money then go to financial institutions. It's the financial institutions that already have enough money. Does anyone here, I'll address this to Mr. Foster, but anybody, have any economic analysis that said, not it's good for your investors, and you do have to be here just, you know, for your investors, but that it's good for the economy to create another pipeline so that investment money goes to those in the financial sector?
Sure. Well, yeah, I mean, we have investments, and that's what Mr. Arrighetti has one too. And probably Mike as well, we have investments in leasing companies that, you know, that might have to occupy a small role in our 30% bucket. And would it be nice to not have to worry about that if another leasing company came in? Because the leasing companies, equipment leasing companies, they're helping operating businesses, right? So just because it goes...
In a lot of ways, they are your business.
Yeah,
they're financing the same people you're financing.
Yeah, so, but, you know, I think our members think that the 30% bucket is adequate to deal with those. We welcome it. You know, it would be nice if it was bigger, but I just don't see it as a priority to...
Should all financial...
Gentleman's time.
My time is expired.
Mr. Huizinga, recognized for 5 minutes.
Thank you, Mr. Chairman. Actually, I'll kind of continue on the line of questioning that my friend from California had. And I might add, while I might question your judgment on things on occasion politically, I would view you as a qualified investor. I would hope that reasonably educated people that can go do this would be able to go in and make these types of decisions. So I'm kind of curious about this sort of this fiduciary issue that seemed to be the pursuit and about compensation. You know, Mr. Gerber, when the little exchange was happening, you had a very contemplative look on your face. I'm curious if you were looking to try to respond to that or any of the others. And then, Mr. Quadman, you had mentioned that from your perspective, real quickly at the end of, I think it was Mr. Neugebauer's questioning about you believe that this could help operational companies, and I wanted to expand on that a little bit. And then, Mr. Arrighetti, you talked a little bit about adequate protection. So it's kind of the direction I'd like to go. And Mr. Gerber, I don't know if you would care to lead off, if you had something to say about that fiduciary element.
Well, I'm not sure exactly which period of the discussion you're referencing, but I think
I think it was like the time of compensation for someone who was giving advice, where that compensation would come from.
Yeah, the thought that was crossing my mind at the time, because there are some related issues between these two bills, and the gentleman from California was asking questions about conflicts of interest, and that's come up with some of the provisions in the BDC legislation as well, where where there could be theoretically an advisor-issuer conflict, and that's something that Congressman Mulvaney has tried to address in the BDC legislation by ensuring that the SEC would have an opportunity to review those types of conflicts, and I think that's an improvement over the legislation, the BDC legislation, and again, not a priority for Franklin Square, but something that we think is important to consider on behalf of the industry and behalf of investors in the BDC industry. And we were pleased to see that addressed in Mr. Mulvaney's draft legislation.
Sure. Chairman Huizinga, the point I was trying to make is in the previous BDC legislation that was considered in the last Congress, there was no such 50% cap on financial companies. So theoretically, a lot more than just 50% could have gone in. So the current draft actually provides a ceiling. Now, I do so theoretically, with that ceiling, you would have a certain amount that would have to go to operational companies. Frankly, if you take a look at the BDC model historically, they're going to be investing in operational companies anyway, but I think this creates a ceiling where there hadn't been one before.
And the vast majority of your investments, right, gentlemen, that actually are involved in the BDCs here, they do go into operational companies, correct?
Absolutely.
Okay. Well, Mr. Arrighetti, you had the mic there. Second, why don't you talk a little bit about the adequate protections that you thought were in there for those investors? And it seemed it was back a little bit ago, so I don't know if you remember uttering that, but
it's interesting because I think people have been focused appropriately on regulation and shareholder protection. I'll just reiterate some of the things that Mr. Gerber said in his testimony, that as far as financial services models go, you can't get more transparent than a BDC. We have a quarterly schedule of investments where we delineate every investment in the portfolio. If you juxtapose that with a bank balance sheet as an example, it would be very difficult for anybody in this room to actually open up a public filing for a bank and figure out exactly what they own. Now, they're under a completely different regulatory regime, so that's not to say that they're bad investments, but I think it's important that we always get regrounded in the transparency and the regulatory framework that we operate under. Vis-a-vis the increase in leverage, a very positive change in the new legislation being introduced is this idea of shareholder protection through a cooling off period. I personally believe that the investor community will welcome this change, and it will actually create a significant amount of renewed interest in the BDC space from both retail and institutional investors. But the idea of giving the retail investor the opportunity over a prolonged period of time to vote with their feet, I think is a very innovative way to give them the adequate protection that certain people are trying to give them.
Okay. Any concerns, anybody, about whether there might be leveraged money allowed to be leveraged again in this if you're changing that ratio? I mean, that had been someone had brought up to me that sometimes these investors into the BDGs are using leveraged money. So my time has expired, but thank you.
Thank you. I know it's recognized. 5 minutes.
Thank you, Chairman Garrett, and thank you, Member Maloney, for holding this hearing. It seems to me that when it comes to innovation, the United States is the envy of the world. And we are such envy not only because of our economy values not because our economy values and rewards entrepreneurship and hard work, but because our markets are transparent, safe, and liquid. My first question goes to Professor Jay Brown. The discussion draft of the Small Business Credit Availability Act creates multiple classes of preferred stock, each with different shareholder rights. With different characteristics and rights, do the new classes of preferred stock pose risk to retail investors?
I think that there are advantages to multiple classes of preferred stock, and of course operating companies today have that authority. I think that this draft legislation eliminates some investor protections that are associated with preferred shares, and that's, I think, of concern. I think the idea that this legislation would limit the purchase of those shares to qualified institutional buyers, I think, is a helpful way to approach that. My concern is actually not with the purchase of preferred shareholders, but the common shareholders. This bill would strip away the obligation to have voting rights on those shares, but it would also allow for things like super voting stock, at least as I read the legislation. There's no regulation of voting rights anymore if this bill passes as is. So in theory, a board of directors could transfer voting rights away from the common stockholders and to the preferred shareholders. I actually have a suggestion in my testimony as a way that I think that should be fixed. I don't think that authority should be allowed.
Mr. Brown, as you know, H.R. 2187 would classify brokers, investment advisors, accountants, and lawyers as accredited investors. The legislation assumes that these persons or entities, by nature of their profession, are sophisticated enough to understand the private securities offerings under Regulation D. Do you have any concerns with these classes of persons being deemed sophisticated under the law?
Congressman, I sure do. And as I mentioned in my testimony, I mean, I know lawyers obviously the best. I teach them. I'm around them all the time. They are not an inherently sophisticated group of people, at least when it comes to investments. You know, the education, we have plenty of lawyers in this room. You know, in your law school education, you're not taught about the intricacies of complex investments. We're lucky if students take corporations or securities at all, and then those courses don't always really prepare you. So unfortunately, the way this is drafted right now, it doesn't take into account age, doesn't take into account experience, and you can't really rely on education as a way of saying that they're sophisticated. So I am concerned about those categories.
Thank you. My next question is to Vincent Foster. Pursuant to Section 413 of the Dodd-Frank, the SEC is currently working on a study of whether it needs to redefine its current accredited investor definition. Rather than jumping in with a legislative fix, do you think we should wait to see how the SEC comes out on any changes to the definition?
I don't think the SBIA really has a position on that because we're dealing exclusively with either SBIC funds that have as their investors accredited investors, or SEC registered companies that have as their investors retail and institutional shareholders, which is accompanied by extensive disclosure and generally full liquidity for the shares. And so, I don't think we really have a position on that.
Okay. Another question is for Mr. Arrighetti. In your testimony, you have indicated that commercial banks and other traditional financing sources continue to retrench the business of providing loans to small and medium-sized companies. Can you elaborate on your prepared testimony and provide us some insights into why you think this retrenchment is happening and what, if anything should be done to ensure that those small and medium-sized businesses have adequate access to capital?
Sure. I'll try to be brief. It looks like we're pressed for time, but I think it's important to put this in historical. I'm sorry, Mr. Chairman, should I?
No, you can finish.
To put it in historical context, because the shift from banks to non-banks, or what we would call parallel banks, has actually been occurring for about 25 years, and it started in the late 1980s with a big wave of bank consolidation in this country. So I just think it's important that we clear the misperception that this is a post-Great Recession issue. This has been happening in this country for 25 or 30 years. I think it has accelerated post the Great Recession for a whole host of market-based and regulatory reasons, but I don't think there's any one issue. I think something that has gotten some discussion is also just talent. I think a lot of the folks like ourselves who were classically trained within bank credit programs have frankly fled the banking industry and now reside in firms like BDCs, and I think that's part of it.
Thank you.
Thank you. I yield back.
Thank you. Mr. Stivers.
Thank you, Mr. Chairman.
5 minutes. Thank you.
Thank you, Mr. Chairman. I appreciate you holding this hearing on this very important issue of access to capital and capital formation in our economy. And as the chair of the Middle Markets Caucus, I know how important middle market companies are, not only in Ohio, but throughout our country. They represent about 200,000 businesses, about a third of our economy. They employ 47 million Americans, and BDC loans in that middle marketplace have tripled, in fact, over the last, since 2008, I believe. So a lot of money. Currently, BDCs have about, I think, and somebody can correct me if I'm wrong, about $70 billion of outstanding middle market loans. So my first question is for Mr. Arrighetti. Can you please help this committee and everybody understand how this bill would help impact capital access to these very important middle market firms by allowing BDCs to have greater access to capital and leverage?
Sure. I think a real-life example, but just to understand why BDCs are so attractive as capital providers, We're permanent capital vehicles, so we have many of our portfolio companies who view us as their bank, their lender of choice, and we try to service them throughout their entire life cycle. So we have 250 portfolio companies, a number of whom we've been lending to for 10-plus years in a whole variety of different ways. It all comes down to scale and product capability. And the broader our product set, i.e., if we can service those same clients and customers with senior secured asset-based loans that currently don't meet the economic requirements of the BDC, that will be a good thing for those underlying companies. To the extent that the banks can provide some of that marginal credit, I think that's a good thing as well, because that just promotes more competition and more healthy cost of capital to the investors. But I think it's really about the increasing mandate that the asset coverage test would provide us.
Well, I appreciate that. And, clearly, BDCs add value to the economy, are adding a lot of value to these middle market companies that are in many cases family owned, in a lot of cases fast growing, and employing, as I said, 47 million Americans. So I want to thank all of you for your willingness to do that. I do want to quickly hit on transparency and protections, because I think that's important. With regard to transparency, I think, Mr. Gerber, you said it really well when you talked through the quarterly reports you have to do, where you do a whole review of your portfolio by company, by amount. No bank does that. No other financial institution in the capital markets has that kind of transparency, do they?
That's right, Congressman, and I think that's one of the reasons why we're all very comfortable making the recommendations we're making. It's because of the power of the transparency behind the model of the BDC. And you're right, when you compare us to other lenders, even if we were to go to 2-to-1 leverage, it would still be far less leverage, and I think Mr. Arrighetti addressed this in his comments, far less leverage than the other lenders against which we compete. And I mentioned it earlier as well. Banks are anywhere from 8 to 15-to-1. Hedge funds are in the mid-teens. We're just talking about 2-to-1, but it's 2-to-1 in a far more transparent model. So as Mr. Arrighetti said, you cannot go to a bank's balance sheet or filing and find a schedule of investments like you can in a BDC. And we all know you certainly can't do that in a private fund, whether it's a private credit fund or a hedge fund that's engaging in lending. So it's the most transparent form of lending in the marketplace, and even if we go to 2-to-1, it's one of the lowest levels of leverage.
And I'd like to just give you a second to expand upon that, because today you are absolutely the lowest leverage, at 0. But if you went to 2-to-1 leverage, that would be between 4 and 10 times less leverage than your competitors in the marketplace employ.
That's right.
Thank you. And the last thing I do want to hit on is protections with regard to accredited investors. We all did laugh at the lawyer joke, and I think we should cut all their bills by about 50% because of how unsophisticated they are. But I do think that I was in the investment advisor business. If you pass a Series 7, you're pretty sophisticated, I would argue. If you pass, my sister's an accountant, and their exams are really hard. You're pretty sophisticated if you're an accountant. We can all debate the attorneys, I'll give you that, but clearly most people in those professional educations are way more sophisticated than just being worth $1 million. Would you say that makes somebody more sophisticated than just being worth $1 million, regardless of how they got it, Mr. Gerber?
I don't consider myself an expert on this one,
okay,
Congressman. But what I would like to say to you is that when you just look at arbitrary numbers, I don't think you're getting into a substantive consideration. And I think the proposal before us is driving at the notion that we ought to be considering something other than just arbitrary numbers. And I don't know that anybody on this panel would disagree that sometimes the substance of someone's background may be more meaningful in terms of their level of sophistication than just the assets that they have in their possession.
Thank you. Thank you all. I'm out of time. I yield back the balance, but thanks for being here.
Thank you. Gentleman yields back. Mr. Lynch, gentleman from Massachusetts, recognized 5 minutes.
Thank you, Mr. Chairman, and I want to thank the members of the panel. You've been helpful. Let's drill down on that a little bit, though. Under the terms of the bill right now, H.R. 2187, a personal injury attorney with no other requirements would be able to self-certify as an accredited investor. Isn't that right, Mr. Quadrin?
I believe you're correct, and that's one of the reasons why we said there should be an SEC study to see exactly what
Right.
those characteristics are. So,
Right.
we think Mr. Schweikert's going down the right path, but maybe it's also good to have the SEC look at it and then report back as to what some of those substantive different changes should be.
Right. I totally agree. And I think for the CPA side of this, someone who does your taxes once a year doesn't necessarily know that we're talking about, in many cases, 27 of these BDCs are private. They're non-traded. So they're rather opaque investments, and I don't think the average tax attorney or personal injury attorney, would necessarily be able to drill down and make a good determination whether or not that investment is right for themselves or for others. The bill also says that as long as you hire a registered broker-dealer, that allows you to make that investment as well in a BDC that might not have the information public. And Mr. Brown, does that create a problem?
I certainly believe that it does. If we go back to my 85-year-old parent or uncle or friend, and we were to say if they happened to have a lawyer who maybe was their estate planner or a CPA, as you say, who was doing their tax returns, and those two people gave them some investment advice, is that person really suddenly transformed into someone who is sophisticated,
right,
just by virtue of the relationship? Not necessarily.
Okay, I want to ask you something else. Professor Brown, as you're aware, Congress passed and the regulators have finalized the Volcker Rule to prohibit banks from using their taxpayer-backed deposits to make proprietary trades. The final rule accomplished this by requiring banks to divest from certain assets. However, BDC funds were excluded from that definition, and for purposes of defining affiliation as well. BDCs were not considered to be affiliated with a bank so long as the bank's ownership of the fund was under 25%. Recently, Goldman Sachs took a BDC public. They retained a 20% share in the company. Credit Suisse has also formed a BDC. I'm not sure what their retention is. Should we be concerned now that even before the Volcker Rule is effective, we're already tinkering with an asset class that may enable banks to re-engage in proprietary trading?
I can say that it concerns me. And my concern is, there are a couple of them, but one of the ones is that, banks, when they form these other entities, especially when it's the big commercial banks, the market just judges them differently. Sometimes the market thinks that the big bank is making an implicit guarantee of backing that company, even if they only own less than 25%.
Right.
That other company gets a break on the company can borrow at a cheaper rate. It might be able to do things that other BDCs can't do. So I worry very much when banks get into space like this that it may dramatically change the nature of that market, and it frankly may give them a competitive edge that other BDCs don't have.
Okay, thank you very much. Mr. Chairman, I yield back.
Thank you. Gentleman yields back. Gentleman from Arizona, Mr. Schweikert, the author of the legislation before us today.
Thank you, Mr. Chairman. And we'll walk through a couple of the things and maybe one or two of the misunderstandings and then work a little backwards from there. First off, I think for all of us here, there's an understanding we have both a societal problem and some other mechanical problems. My understanding is out of our 318 million population right now, we have only about 600,000 Americans that have gone through the process that are qualified investors. We know that half of our baby boom population is moving into retirement with very, very little savings. So part of our goal here is how do we move more of our population into the investment class and do it in a safe and rational fashion. And so I'm actually, working on this bill for a while, but quite open to any brilliant suggestions. I do want to go over a couple things just because one I think was sort of a misunderstanding or misstatement. Under current legislation right now, under current law 506, if you're the lawyer, if you're the CPA, if you're the registered broker-dealer, you get to certify someone as being a qualified investor. It doesn't make you a qualified investor.
The second part of that is the way the bill is drafted right now. If you were to hire one of those people for guidance, it would allow you to invest in some of these products. Maybe that's where it needs to be tightened up. And my first question, Mr. Chairman, and it was actually to Mr. Brown. Just one quick one. You're actually on the SEC's committee that's been somewhat looking at the definitions of qualified investor.
Yes, sir, I am.
Would I be pushing the limit of getting too complicated and too, I'll use the word sophisticated, to also look at it as saying a 30-year-old that just happened to do really well that year that has $50,000 of risk capital is a lot different than your 80-year-old mother example. Would you be also willing to support an idea that also would put some time as part of one of the counterbalancing, or age as one of the counterbalancing factors?
Yeah, absolutely. And when I read your draft, there is no question in my mind that that was a good faith effort to try to address a problem that the Investor Advisory Committee agrees is there, which is how to let people who are sophisticated, in fact, actually sophisticated, irrespective of the dollar amounts, to invest. The definition should allow for that. We're in complete agreement. I should say I am, but the committee's recommendation. I do think, for example, in the testing area, in your language in the bill, I think there should be a provision in that says the test only lasts for so long. I think if somebody's 30 and then I don't want them to have taken it once and at 80, that's fine.
Well,
so there should be some.
But for those of us who do really well on, multiple guess tests, we like that. Mr. Quadman, what would you suggest in the world of, would you be comfortable with a world where a broker-dealer could provide advice to someone to invest in what today is limited to only qualified investors? And if not, how would you tighten it up? What would make you comfortable?
My concern there is you could take an unsophisticated investor and effectively using the accredited investor patina of the broker-dealer and then transfer it over to that unsophisticated investor. And that's where I think there's some issues where even though there's advice that's been given, that the unsophisticated investor, just by definition, may not necessarily understand the risks that are involved.
If we created sort of an A/B test in the legislation saying also demonstrates some risk capital or something of that nature, would that
and that's where I think we need to get to, is that you need to ensure that the investor has a level of knowledge that they can understand what the risks are that they're undertaking. And then you also want to have something else there to make sure that the risks that they're taking is commensurate with their financial experience. And you can take the flip side too, because if you take a look at the bright line test, right, what is interesting there, because I talked to somebody who was at the SEC in '82, they picked those tests because they couldn't really figure anything else out at the time.
Mr. Chairman, in the last 30 seconds, and I think all of us have come across this experience, have a very good friend, PhD in electrical engineering, had some friends that had started a business. He's an absolute international expert in this subject, except he wasn't allowed to invest in it. How do we reward people, both from their risk tolerance, where they are in their life cycle of investing, but also their knowledge base, and get rid of this sort of arbitrary that you've made it in life, you get to continue to make it in life. Because you're on this side of the ledger, you don't get to participate. We are quite open to any brilliant ideas that will come our way. With that, I yield back, Mr. Chairman.
The gentleman yields back, looking forward for more brilliance from Arizona on the legislation. Then we now go to Connecticut, and Mr. Himes is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here for the duration. I am encouraged by what is a robust and substantive bipartisan conversation. I do have, though, a couple of, and by the way, I appreciate Mr. Mulvaney's offer. I have a couple of concerns that I'd like to have addressed here. The first and most important pertains to the levels of leverage that would be permitted under the Mulvaney proposal. Specifically, if you start to do the math on the 30% bucket, where, as you know, there are plenty of firms out there that are holding equity tranches in CLOs, which themselves are 7, 8, 9, 10 times levered. When you start to do the math on going to 2-to-1 leverage in these instruments, on investments in financial companies which may themselves have 3 or 4 times leverage, investing in instruments which themselves may have 7, 8, 9 times leverage, you pretty quickly get to some pretty stratospheric leverage numbers. It's not hard to get up into the sort of 70x leverage numbers if you just work through that math. And of course, if you then expand the 30% bucket into 50%, you have conceivably, and I understand that there will be some prudence exercised by some players in the industry, but you potentially have a very highly leveraged vehicle here. So I wonder, and let me just start with Mr. Gerber since he's in the business, and then I would welcome comment, but am I right to be concerned that if we permit this degree of leverage, you have essentially a very, very volatile instrument? I mean, I don't need to tell you that at 50x leverage, a tiny fluctuation in the value of the underlying asset puts this instrument completely underwater and eliminates the investment of a lot of retail investors for whom this product is created. So, Mr. Gerber, make me feel more comfortable on that issue.
I'll make my best effort. I think in the question, you're raising really 2 issues that are distinct, but at the same time, when brought together, you have to consider it as a whole. So on one hand, it's increasing leverage, going from 1 to 1 to 2 to 1 in our debt-to-equity ratio. On the other hand, it's the redefinition of an eligible portfolio company, moving something out of the 30% basket that we talk about into the 70% basket. And I think what you're getting at is if you combine the 2, what's happening to a term that we all are familiar with, effective leverage. You're looking at 3 of the BDCs in the space that have lowest levels of effective leverage. And different people have different ways of defining effective leverage and doing different calculations. And I think when you look at any lender, whether you're looking at a hedge fund or you're looking at a bank, you have to ask the same questions. And so what you're essentially looking at is the multiplier effect, if you will. And in our case,
that's the math I was doing. And again, yeah. I get that you guys are prudent, but
well, if I may just finish
on the less prudent side. I mean, I want to check my math first. I mean, again, you could very quickly see very high degrees of leverage in this instrument.
Yeah, I think so, and that's why you hear some expressions of concern up here at the panel. And I think that's one of the areas of legislation where we still have some more work to do as an industry and the members of the committee. And I think we're all committed to doing that work together. What I wanted to mention is earlier when Mr. Arrighetti was talking, and I referenced this concept as well, about would all of the BDCs be able to access more leverage? And the answer is no, they won't. And they won't whether it's because of the rating agencies that Mr. Foster talked about, they won't because of the covenants that the banks require, the regulators require the banks to have in their loans to us. They won't because the analyst community and the investor community is going to look at the substance of those portfolios. And so if you see mission creep, if you will, if you see growth in the overall BDC in FinCo investments, you're going to see downgraded ratings, you're going to see BDCs potentially violating existing covenants. So there are these natural governors in place. And I think as we work through this language and think about the full impact of it, we have to keep in mind those natural governors that are in the system.
Could the industry, and I don't have a lot of time, could the industry live with a modification whereby those investments in companies, in the small businesses for which this instrument was created, were allowed to lever 2 to 1, as is proposed, but in the 30% bucket or in the financial bucket, the 1 to 1 ratio obtained? Is that a reasonable proposal?
Yeah, I think we've heard that. I think it'd be somewhat complicated to sparse it out like that. Money is fungible. So I think in effect what you really would be saying is instead of going to 2 to 1, you're going to 1, 7, 5, and 1 or something along those lines. Whether or not there's a practical way to ensure that any increase in leverage isn't being applied to some subset of investments, I think would be somewhat difficult.
Thank you.
Thank you. Thank you, Mr. Chairman.
Mr. Poliquin, 5 minutes.
Thank you, Mr. Chair, very much. I appreciate it. Thank you, gentlemen, for all coming today. If we all as a country look at the state of our economy, where it's gone and where it is going, the last 5 or 10 years
my understanding is about 80% of the new jobs hires in this country are in the small to medium-sized business space. So we want to make sure that we do everything humanly possible to help our small businesses grow. I just looked at a survey a short time ago saying something like 42% of business executives believe that the lack of financing is one of the key reasons that they just don't have the confidence to hire more workers and grow their business. So I know that Dodd-Frank is a smothering regulation that's reducing the available credit among lots of players in your space, and so I salute you folks for trying to fill that void. I just heard something, Mr. Gerber, a short time ago that I want to drill down with you a little bit, if I may. Something that for a non-traded BDC like you folks, that the information that's provided tends to be opaque. Now, we want to make sure that investors who are investing in these sort of financial products, that they have all the information they need to go forward. Could you address that, sir?
Sure. Thank you, Congressman. It's often a misconception with non-traded, because when you hear the term non-traded, it just sounds different. But non-traded BDCs follow all the same regulatory processes and procedures as traded BDCs. So non-traded BDCs are 33, 34, and 40 Act. We have all the same public disclosures as traded BDCs. At Franklin Square, we manage both traded and non-traded BDCs, and we manage more non-traded BDCs than any other manager. And I can just tell you the hours that our legal staff and accounting folks put into those filings is significant. But just because we're non-traded does not mean we're opaque. It does not mean that we're not providing the same level of disclosure that traded BDCs provide. We absolutely do.
Okay, so contrary to what was said here today by a member of this committee, is that an investor would have the same type and same amount and detailed information if I'm buying a traded or non-traded BDC. Is that correct, sir?
That is, and actually more, and let me explain to you why. Because when a firm like Franklin Square distributes a non-traded BDC, we also fall under FINRA and Blue Sky regulations. So all 50 states are regulating our products. We're filing in all 50 states. We have to meet the suitability standards in all 50 states. The advisors and brokers that put their clients in our funds have to get a wet signature from their clients, our investors. So the reality is the non-traded investor probably has more opportunity to understand the investment than even an investor in our traded BDC. So it's, I'd say, even heightened for the non-traded investor. More disclosure, more transparency.
Thank you for clarifying that, Mr. Gerber. I appreciate it very much. You bet. Now, fellas, I want to pivot a little bit here, and we only have a couple minutes left. I'll start with you, Mr. Arangetti. You folks and all the folks in the financial industry space live under this net, this Dodd-Frank net, which was intended for a small number of money center banks that really have tentacles throughout our economy that could cause a problem if something happens, but certainly not designed for everybody. I want to know if you could wave a wand. What one regulation now within the Dodd-Frank net would be best to remove, repeal, reform, such that you folks are able to grow your portfolio companies and hire more workers?
Yeah, I'll answer. We're not Dodd-Frank regulated, so for us, we're not focused on Dodd-Frank. As we've said numerous times, we are heavily regulated under the 33, 34, and 40 Act. And I think Representative Mulvaney has done a wonderful job putting forward legislation that would actually advance the industry.
What about you folks possibly being regulated by the DOL or by the Federal Reserve instead of the SEC? How does that make you feel?
Well, it comes with a different set of regulations and a different set of opportunities. So as I highlighted earlier, if we were a bank and we were levered 10 to 15 to 1 and we took depositor money, we would be subject to a separate set of regulations versus 40 Act closed-end fund who is taking retail and institutional investments. So again, for better or for worse, haven't put myself in that theoretical construct. We're focused on the regulatory regime that we're subject to.
Okay. Mr. Foster, you want to add anything to that?
Sure. I asked our lead investment bank, Raymond James, if the DOL rule that's about to come out would impact them, because a lot of our shareholders are individuals, but they invest through IRAs and 401ks, and they canvassed their system and did not think it would be significant. But you'd think it could be.
Great.
Thank you.
Mr. Quadman, would you like to, in my waning seconds here?
Yeah, just to, investment advisors are extremely concerned about the fiduciary duty rule. That is going to have a very significant impact on their ability to invest. In fact, we issued a study last week that 9 million small businesses in the United States are going to be prevented or severely crimped in their ability to provide retirement vehicles for their employees if that rule goes through.
Thank you, Mr. Chair, for the additional time. I yield back mine. Thank you.
Thank you. The gentleman yields back. Mr. Carney, 5 minutes.
Thank you, Mr. Chairman, Ranking Member, for holding this hearing today. Thank you to Mr. Mulvaney, Mr. Swikert for these proposals. I'd like to, I got to admit, I don't know a lot about BDCs, and so I've found this, your testimony very interesting. And I have just really 2 questions. One is to you, Mr. Foster. On page 5, I'd like to understand a little bit about how these BDCs are operating in my area. I'm the representative from the state of Delaware, the whole state. It's a very small little place. But I notice on here it's got a pretty big number under it on your map on page 5, particularly relative to states that are much, much larger. Can you explain that? Is that a function of our fact that we are the state to incorporate your business? Does that have anything to do with that, or is that a function of greater BDC activity in my state?
I can't really explain why there's I guess it says $1.5 billion.
Yeah, we're doing better in New Jersey,
Oh, yeah.
Connecticut, Maryland, just about.
But maybe one of the 2 Michaels.
Anybody else? Mr. Gerber, you're from our region, right?
Yeah, I think what Mr. Foster wanted to say, it's the excellent representation in Congress that is driving the heavy investment in Delaware. No, I think you hit the nail on it.
Flattery will get you everywhere, but you can't vote for me.
At Franklin Square, we have a portfolio company. It's U.S. Coatings Acquisition. I do think it's in part because of the corporate laws in Delaware and the number of firms that are
More
headquartered
function
there.
that these are domiciled in some kind of
I think
way.
that's exactly right. Now, in our case, our investment has more to do with just the work that is done at the portfolio company, but I think the phenomenon you referenced is...
Obviously, you're located in our region. Is most of your activity in the region?
No, as I mentioned so earlier in my testimony, we've deployed capital in 39 of the 50 states, and between the 3 of us and our entire industry, we've invested in companies in all 50 states. I think it probably depends on the scale of the BDC. In our case, we have the largest platform. We have national reach, so we're sourcing deals all over the country.
So I think this is a pretty reasonable approach to updating regulations for BDCs. I do share Mr. Himes's concern about the leverage question. So I'd like to kind of follow up where he left off, which was, is there a way, Mr. Gerber, you started to respond to how you might consider addressing that concern. Would you like to follow up on that, or Mr. Arrighetti or Mr. Foster, would you like to address that?
I'll give a couple of comments.
Please.
And it harkens back to some of my
earlier just gives us a little heartburn, you know.
Yeah, I think anybody here would struggle to actually get leverage on the types of investments that you're expressing concern over. So first and foremost, the draft legislation, as I read it, excludes CLOs, and Representative Himes mentioned CLOs. That's excluded. However, Ares is actually one of the larger CLO managers in the broadly syndicated market, and getting leverage on a CLO equity investment is not possible in the market. So it goes back to some of the natural governors that exist in both the banking sector and the investment-grade bond sector that regulate what can and can't be leveraged. So if we put together a portfolio that was 50% CLO equity, even though it's excluded, but for argument's sake, if we did, and we took that portfolio to the rating agencies and the bank, we would not have an investment-grade rating, and we would not be able to get a loan on it. So you should...
So there are market-based controls on that, is what you're saying?
Yes, market-based bank and capital markets.
Gentleman, yield for a second, Mr. Carney?
Sure, absolutely.
Very briefly, and I appreciate the question, just to, because I was hoping to get to this when Mr. Himes was still here, the draft legislation specifically excludes investments in CLOs, hedge funds, and private equity. So some of the examples he gave would not have been permitted under the draft legislation.
Great. Anybody else?
Yeah, I'll add, I think it's, we've given some thought about it. I think it's theoretically attractive to provide the one-to-one to the 70, but not the 30. But if the 30 gets bigger, then the bill begins to lose its effectiveness. And I am concerned because most of us are owned, all of us are owned primarily by retail investors, and they get one-to-one or they get two-to-one. But when you start explaining the baskets and how we're going to report that to them and how we're going to monitor it and what it does to this, I don't think it's a practical solution.
So maybe what we could do is get some feedback to those members who have concern. I'm looking at the sponsor just to give us some level of comfort that that's great. I yield back. Thank you.
Thank you, gentlemen. Looks like our last two questioners, Mr. Holmgren and then Mr. Mulvaney. And then we vote, I think.
Thank you, Mr. Chairman. Thank you all for being here.
No, not on your bill. You looked as if we're ready to vote on your bill, but no, on the floor.
I thought you could pull some strings on, Mr. Chairman.
I just look at you in a confused fashion most times, Mr. Garrett. That's nothing new.
It's kind of a normal look. Thank you all. Appreciate you being here. I do want to thank all of you for your input and the work that you're doing. Thanks, Mr. Gerber, for your clarification, too. I think there was some inaccuracies that I had heard of some statements on the other side with some of the non-traded BDCs and some statement that those were less than transparent, and I really appreciate you clearing that up, that there's incredible amount of transparency and accountability available there, and that was very helpful. I want to shift gears just a little bit, if that's all right, and I think I'll address this first one to Mr. Gerber, but then also Mr. Foster, Mr. Quadman. I would appreciate your thoughts on this as well, and maybe Mr. Arrighetti as well, but we've heard a great deal about access to capital, its role in creating jobs. I wonder, could you tell me a little bit more about the reality of how your business, Mr. Gerber, how your business helps with job creation in the middle market?
Sure. In its really most basic form, companies are coming to us looking to grow or looking to stay in business and in need of capital. And when we provide that capital, and as Mr. Arrighetti explained, sometimes because of the permanent nature of our funds, we can be long-term partners and provide managerial assistance to these firms. We're helping them stay in business and we're helping them grow. And it does have a direct impact on jobs. In your state, Congressman, Franklin Square alone has 10 portfolio companies. We've deployed over $380 million and to firms that represent over 33,000 jobs. Across our entire portfolio, we've invested in over 300 companies representing more than 1 million jobs. And you heard earlier in our testimony and some of the comments from some of the members of the subcommittee, we're lending primarily to small middle market all the way up to large middle market firms, and they now represent 1/3 of the private sector workforce. So there's a direct correlation between the work that we do in deploying capital and the growth of the middle market and the job creation in the middle market.
That's fantastic. I appreciate it. It's kind of the number one thing we continue to talk about is job creation and how do we get this economy growing more quickly. And so it's great news, especially for my state in Illinois. We are looking for good news. So it's nice to hear about jobs being created there. Mr. Quadman, any thoughts from your membership of what you're hearing as far as access to capital and specifically this tool that really is potentially beneficial on both ends, certainly from the investor side, but also from the recipient of access to capital?
Yeah, we are seeing very severe problems in terms of access to capital that primarily with small businesses and larger businesses. Part of it is the slow implementation of Basel III, which is slowly drying up bank loans. But we're also going to see if total loss absorbency coverage goes through in 2019, that's actually going to siphon hundreds of billions of dollars of capital out of the global markets. So what we're seeing is a slow combination of events happening that logically you could take each of these different regulatory initiatives, they would make logical sense by themselves. When you put them together, they have very dramatic impacts. And what we have seen, and this is a Census Department report I had mentioned, I think in April, is that we're seeing a net destruction of firms in the United States over the last 6 years. So we're not seeing the smaller firms being created at the same rate that we used to. So the BDC legislation is good that we're helping the middle market companies and the like. So, but we need to help the smaller guys as well.
Yeah, and it's something that is really part of my heartbeat is I just believe so strongly that the really foundation of this country is the ability for someone to have an idea, be passionate about it, have some gifts and talents that they want to put into this, but also to have partners that can come alongside where they can get access to capital to turn that into truly the American dream. We talk about that, but this is the reality. But so, Mr. Foster, Mr. Arrighetti, any other thoughts on this as far as job creation with this access?
I'd make one additional comment, which I don't think we've mentioned before, is that by regulations, BDCs are actually required to provide managerial assistance to their portfolio companies, which is often overlooked but also contributes to the strategic value that we add to middle market companies. So to put that in perspective, within Ares Capital Corporation, we sit in on or sit on the boards of directors of over half of our portfolio companies. So our portfolio companies look at us as their banker, their lender of choice, but I think they also look at us as a strategic advisor as they grow their business.
That's great. I don't think that was something I understood fully, that the value that could come from that, and learning from other companies that are succeeding, and quite honestly some that haven't, learning from successes and failures can be certainly beneficial to these small and medium-sized companies as well. Mr. Foster, any last thoughts?
Yeah, I mean, a good example is we specialize in change control transaction with retired business owners. Kids aren't in the business. They're too small for a public company to buy, too small for private equity. We'll come in there and arrange a change control transaction. And in the last 10 years, prior to retirement, the last thing they want to do is open up a new plant. So very frequently, we're able to come in and regain a growth trajectory. And if it wasn't for us, not only are you creating jobs, you might not even retain those jobs.
Yeah, it's big. My time's expired. Thank you all very much. Thank you, Mr. Chairman. Yield back.
Thank you. And to have the last word, Ms. Mulvaney, and the sponsor of the underlying legislation.
Thanks, Mr. Chairman. Thanks as well to Mrs. Maloney for the work she's done on this bill with me, along with a couple other members. Thank you, Mr. Carney, for sticking around, because I want to address a couple housekeeping things. First, Mr. Chairman, I've got the statements from Prospect Capital, who is a BDC that has done business in my district, and they'd like to enter a statement of the record, so I'd like to do that without objection, if I may, please.
So ordered.
Thank you. Mr. Carney, we talked before, and I think we addressed some of that stuff about specifically excluding it, but we'll continue to talk. But one of the things I'll point out when we have these discussions is that while everybody gets a little bit nervous every time we talk about levering up or increasing anybody's leverage, I direct your attention to the screen. Even with the proposed changes, this is still going to be the least levered of any of the major investment facilities that we sort of have oversight on in this committee. So it's still a very, very small thing. And all of the rest of the financial institutions that you see on the board have the same issues that Mr. Himes may have raised. So if we want to start worrying about layering on leverage, maybe the place to start is on the left side of that graph and not the right side of that graph. Thank you if you take that down. Regarding the buckets, it strikes me, and Mr. Himes raised this as well, while I understand his point about perhaps his suggestion of not allowing it in the financial services area, part of the reason we're doing this is because small and medium-sized financial institutions are having difficulty getting to capital. So we're trying, that's actually one of the expected uses in my district. I'm a very rural area, we're heavily community banked, and we're trying to figure out a way to provide them with additional sources of capital. Plus, it strikes me that a well-run community bank or small financial institution would probably carry less leverage than some of the operating companies that Mr. Himes mentioned. So I don't think it's a connection between leverage and the bill. I think it comes down to can we make smart, safe, sound capital available to as many people as possible. That's the purpose of the bill, and I see no reason to arbitrarily limit it to having financial institutions getting one level of leverage and the operating companies, for lack of a better word, getting another. Mr. Lynch mentioned go-around on Volcker, and I'll throw this to the panel because it strikes me, gentlemen, that if I was, he mentioned Goldman Sachs, I can't remember the European bank he mentioned that was thinking about doing this. If I wanted to get around Volcker, there's a lot better ways to do it than invest in BDCs, aren't there? Mr. Gerber?
As Mr. Arrighetti said, Volcker doesn't apply to us, but I do think that when we see banks investing in BDCs, it's actually a positive consequence to some degree to the Volcker rule in that those assets are no longer on the bank's balance sheet, and they're now being invested in a far more transparent environment than in a merchant banking private operation. So from our perspective, we don't, Volcker doesn't apply to us, but in looking at it, it doesn't seem to us to be an end run around Volcker.
Right, and that's a good point that I don't think lots of folks are familiar with. When you say Volcker doesn't apply to you, that's not by accident. The rule actually specifically excludes you folks under the rationale that these industries are already so heavily regulated and so transparent that there was no reason to apply Volcker to you folks. And again, I would suggest that if I'm Deutsche Bank or Goldman Sachs and I want to go around Volcker, I can put my money in a hedge fund and do it right away. I don't have to go through the hassle of going through the BDC application. Dr. Brown, you mentioned something at the very outset of your testimony about operating companies versus financial institutions, and again, I don't want to change your words, but I thought you said something to the tune of the operating companies need it more than the financial institutions, or...
No, I don't think I quite said that, although, you know, who knows, I could have misspoken. What I really said was I haven't seen the empirical data that says the financial companies need it. What we know is the operating companies do need it, and I'm afraid of the bleed of funds away from operating companies to financial companies and hurting those companies. And I would just add, Congressman, that, you know, the comment that was made earlier about you know, these operating companies get not only the funds, but they get the managerial assistance. I don't know whether the financial companies need the managerial assistance in the same way I think a lot of these operating companies do. So I think if these operating companies can't access as easily these BDCs, I think that's a problem for the operating companies.
Two things to consider, Mr. Brown, and to my colleagues of both parties. Number one, it seems that the need for the product would be dictated by the market. And not by some empirical research. If either it's there or it's not there. But perhaps more importantly, to your point, if these gentlemen want to take an equity position or a debt position in a community bank in my district, I know where the money's going, which is to the local businesses. So, yeah, it's just another way to get the money to the operating companies. That's what the community banks and the small financial institutions and small investment operations in my district do. So if the demand is there within the operating business community, I think capital should be able to find a way there. Lastly, Mr. Brown, I'll close with this. I got 14 seconds. You mentioned some concern about the different levels of stock, the different classes of stock, the preferred stock. And I guess I can only ask it this way. Wouldn't those concerns that you raised here today apply to any company that offers preferred stock? Because a lot of companies publicly traded that I could buy this afternoon offer preferred stock. Aren't your concerns that equally apply to them as they would be to BDCs?
Well, of course, not investment companies, but operating companies, yes.
Right, but if I'm an investor, I'm either going to invest in BDCs or I'm going to invest in Norfolk Southern Railway, and they might have a preferred stock, and the BDCs might have a preferred stock, and the concerns that you raised would apply equally to me as an investor as between BDC and Norfolk Southern. You said the board of directors could change the voting rights, they could change the payouts, they could do that, and me as an unsophisticated investor might get caught in that. That applies anyway, right, in the market?
You're absolutely right. The legal authority exists irrespective of the company because it's the authority of the board of directors. But what I would say is right now there are protections in the Investment Company Act of 1940 that don't exist for other companies. So we're talking about removing something that's there that does not apply to operating companies.
Fair enough, gentlemen. I appreciate the additional 50 seconds and for the right to participate in the hearing since I'm not on the subcommittee. Thank you, Mr. Garrett.
Thank you, and welcome to the subcommittee. So I said that was going to be the last word, but no, I'm not going to say the last word. I'm going to give the last word to the gentlelady from New York.
A vote has been called, but very briefly, thank you to all the panelists, and I ask unanimous consent to place 2 letters into the record, one from the National American Securities Administrators and one from the Consumer Federation of America. And I look forward to continuing to work with you, Mr. Mulvaney, and see if we can get a product that has unanimous bipartisan support. Getting capital out is important. Thank you.
So ordered. And again, thank you to the witnesses. Members have additional time. They may have additional questions. I know I have some additional questions to submit those, so therefore the record will remain open for 5 days for the submission of the record and for extraneous material. And with that, this meeting is called to adjourn. And then again, thank you to the panel.